This is Scott Becker with the Becker Private Equity and Business Podcast. We come to you regularly with short business episodes, short private equity episodes, interviews with business and private equity leaders, as well as body of life episodes. Today, we're talking to Matt Wolf, senior leader at RSM. And one of the things that's fascinating that's going on right now is renewed consolidation in both professional services world as sort of sparked the discussion with the CBIZ discussion of the acquisition of another accounting firm, Markham, that would make them the seventh largest accounting firm in the United States, well behind the big four in RSM, but still fairly large at $2.8 billion in annual revenues if they get that deal done. Also seeing tremendous consolidation in money management firms. Matt, what's driving all this? What are you seeing out there?
Yeah, thanks, Scott. I think it's an interesting dynamic, and a big driver of this, particularly in some of the business professional services area, is leveraging technology and automation, AI, which is a story in some other industries too. But I think with this sector, kind of the sector I operate in, even though I primarily observe or advise healthcare, but in the BPS area, like these technology improvements haven't totally been necessary in the era of cheap money. And now, as we go through this regime change transition towards this anti-fragile economy where, kind of away from the growth at all costs, away from the winner takes most sort of environment, sponsors are reevaluating their investment and operational thesis, and they're looking at business professional services, law firms, accounting, everything else, and saying, okay, well, they're still highly fragmented, and the last big change in the industry was when Microsoft launched Excel, right? So we can bring a lot of improvements and operational efficiencies to this fragmented industry and drive returns, and also too maybe get a little bit of insight in potential deal flow, looking at middle market clients and their data and things like that. So it's kind of a multi-pronged effect, but we're going to continue to see more consolidation, more announcements of large deals like we saw yesterday, in particularly in accounting, CPA firms, but I also think across sort of professional services in general.
Thank you. And what do you sort of see in terms of sort of the private equity market? I mean, you're starting to see people deploy capital again. Is that going to pick up some? What do you see there?
Yeah, absolutely. So I think, more broadly, we got confirmation yesterday that we'll probably get this rate cut in September. We think at RSM that we'll get one in September, get one in December, and then quarterly through 2025. And this is really priming the pump for capital deployment across the private middle market area, right? Whether it's private equity, private debt, or both. We're going to see money being deployed there. And, instead of the capital going towards the next, Uber, the next whatever growth at all costs sort of stake, we're going to see a lot of that rotate into sectors like business professional services or others where they are highly fragmented and are perhaps kind of laggards or behind the curve on technology adoption. And we're going to see an outsized amount of activity in those areas. That's what I expect.
I mean, it seems like there's just a tremendous amount of pent-up deal activity that one way or another has to get done as soon as the interest rate environment gets more hospitable. Just because I saw today KKR saying they're going to try and do 500 million or 500 billion, some crazy amounts in exits that they're behind on. But it seems like that's an indicator for the industry of people behind on some of these exits and what they need to do to clean up their portfolios. Any sense of that or any discussion of that there?
Yeah. There's still a lot of sponsors that have been sort of delaying ripping off that Band-Aid in terms of exiting at maybe a less than ideal valuation, less than ideal kind of cash on cash return. But they need to rotate. They need to focus on making new investments in the new environment, these new vintages, setting themselves up for success in the new macroeconomic cycle. And KKR's announcement, while it's a lot of money, right? The general sort of tone, theme, direction of it, I would say was fairly unsurprising, right? There's a lot of other sponsors in that same exact position. They're just not going to have to exit nearly as much money, but for many of them, it will be painful.
No, it sure seems like it. And you're really caught in this situation with the right now with the economy between this too hot, too cold situation. It feels like to the right sort of level of cold yesterday, where you saw essentially the market explode upwards based on potential interest rate cuts. Now, jobless claims this morning coming in at their worst rate in, I think, 11, 12 months, and that leading to concerns about recession. What's the take there? Any thoughts on this too hot, too cold, and what it looks like?
Yeah, so the jobless claims, there's a lot of seasonal volatility in there too, so I wouldn't read too much into that. Of course, it was a surprise to perhaps the wrong direction, right? We're still kind of in this environment of, is good news or is good news bad news, and vice versa. What I would focus on in terms of the economic health, or some of the recent data I would focus on in terms of the economic health of the country, is the productivity data that we got yesterday, which that significantly surprised to the upside. And that is a leading indicator of wealth creation, of GDP growth, GDP per capita growth, are these productivity enhancements. And we saw some pretty significant gains. We expect to see that to continue to grow. All the other sort of leading indicators in terms of CapEx spending by companies, investment by companies in R&D and intellectual property, that's up massively as well. And yes, interest rates are higher than they were in the previous cycle, but they're pretty consistent with historical averages. And when we have sort of real interest rates in that sort of 3% range, or targeting right now about a 2.5% sort of inflation rate, and we have these productivity gains, I just don't see the case for a recession, but for some sort of exogenous shock, right? Like a further outbreak of war, or some sort of, other sort of one-time event that is sort of outside of the economic data that we can't reasonably predict, right? Otherwise, yes, there's some surprises, some downsides like we're talking about, but the sort of calculated inflation rate really isn't that high. Rates are not that high compared to the historical, as we've seen for the past 100 years or so of the economy. And we have strong productivity gains. We have strong investment in the real economy. I just don't see we just don't have the backdrop for a recession right now.
Thank you very, very much. Matt, always great to visit with you on the Becker Private Equity and Business Podcast. Again, Matt Wolf, Senior Leader at RSM, absolutely brilliant. Thank you for joining us today.
Thank you.